Dividend stocks feel safe, growth stocks feel exciting, but one of them hides a silent tax trap that destroys your compounding every single year. And the truth is, most investors have absolutely no idea it is happening. And here's the crazy part. Even smart investors fall into this trap simply because nobody ever explains how taxes interact with compounding over decades. You might be doing everything right, investing consistently, reinvesting your dividends, and still losing hundreds of thousands of dollars in long-term growth without realizing it. Today I'm going to show you exactly how this trap works, why it quietly drains your long-term returns, and the legal workaround professionals use to beat the system and keep more of their gains. And once you see the difference on a real timeline, it's almost impossible to unsee. If you invest in dividend stocks or growth stocks, you probably think the choice is simply between cash flow now or price appreciation later. But the reality is that both strategies can make you wealthy or quietly steal years of compounding from you, depending on one factor almost no beginner ever calculates: tax efficiency. In this video, I'll answer 3 core questions. First, which strategy actually builds more long-term wealth? Second, why high dividend yields are often warning signs instead of opportunities. And third, how a single ETF structure can combine the power of dividends with the tax benefits of growth, and why many professionals use this trick without ever mentioning it publicly. But before we go further, let's break down the actual mechanics behind both strategies so you understand where the differences start. Dividend stocks are companies that share part of their profits with you in the form of cash payments. Think of stable giants such as consumer staples, utilities, real estate investment trusts, or energy companies. You literally receive a slice of the company's earnings. And for many investors, that steady deposit hitting their account feels emotionally satisfying, almost like a paycheck. Growth stocks do the opposite. They keep every dollar inside the business and reinvest it to expand faster. Think of companies like Tesla, Nvidia, or Amazon in its early days. They don't hand you cash. They use it to build factories, hire teams, launch products, and scale aggressively. One gives you cash flow today. The other promises higher potential value tomorrow. This difference feels simple. But this simplicity hides a massive tax difference later on, a difference that becomes enormous over 10, 20, or 30 years. Many beginners filter stocks by dividend yield. They see 8%, 10%, maybe even 12%, and immediately think they've discovered a gold mine. But this is often where investors walk straight into danger. An extremely high dividend yield is often not a sign of a strong business, but a sign of a falling stock price. If a company's share price drops from $20 to $10 and the dividend stays the same, the yield doubles on paper. It looks incredible. But what the market is really telling you is that something might be wrong. Maybe earnings are dropping. Maybe debt is increasing. Maybe demand is falling. And very often, those beautiful high dividends get cut right after the stock crashes. A stable 3 to 4% yield usually signals a healthy company. A yield above 7 or 8% often signals distress. And remember, even healthy dividend companies still suffer from a unique disadvantage that growth stocks simply do not. This is the part almost nobody calculates, yet it completely changes long-term results. Dividends are taxed the moment they hit your account every single year, without exception. Even if you reinvest them, the tax is taken first. Only the leftovers go back into the market. That means part of your potential compounding is cut off before it ever has the chance to grow. Growth stocks avoid this entirely. If a growth stock goes from $100 to $300, you pay nothing until you sell. Every dollar stays invested year after year, compounding untouched. Over decades, this becomes a massive difference. Imagine investing $10,000. In a dividend strategy, a portion of your return is siphoned off every single year through taxes before it compounds. In a growth strategy, the full amount compounds for 30 years before you owe anything. Even with the same total return, the growth approach often ends up dramatically higher because the compounding base is never reduced. Here's the real lesson. Dividends themselves are not the problem. Paying tax on them too early and too often is the real issue. Professional investors already solved this problem with something called an accumulation ETF. This is a fund that receives dividends from the companies inside it, but instead of paying them out to you, it reinvests them internally. Because you never receive the cash personally, you typically don't pay dividend tax each year. Everything compounds inside the fund at full power. You only pay tax when you eventually sell the ETF. This gives you the growth benefits of tax deferral combined with the performance benefits of reinvested dividends. And over decades, this difference is huge, sometimes adding tens of thousands, even hundreds of thousands of dollars in extra growth. For younger investors, or anyone focused on maximizing long-term compounding, this structure can dramatically increase total returns because it removes the tax friction that slows traditional dividend portfolios. Does this mean everyone should abandon dividend stocks and buy only growth or accumulation ETFs? Absolutely not. The right strategy depends entirely on your personal situation. If you're young and have decades ahead of you, a tax-efficient compounding strategy often grows faster. If you're older and want stability or cash flow to live on, dividends can be the perfect tool. If you can't tolerate volatility, dividend stocks may feel more comfortable. If you want the highest possible long-term curve, tax efficiency becomes essential. It all depends on your age, your risk tolerance, and your goals. Do you want income now or maximum wealth later? There is no universal right answer. Only the right answer for you. Now you know the real tax trap that quietly destroys returns for millions of investors and the simple structure professionals use to avoid it. So tell me in the comments, are you team dividends, team growth, or team accumulation? And if you really want to understand why today's lesson is so powerful, watch my video on compound interest next. Because without understanding compounding, half of what you learned today will never reach its full potential.